What's up, everyone, and welcome to an all-new market update video. What you're about to watch is a training that I did for our team to help them understand how we're coming into 2022 and what we're likely to see in 2022. So if you're looking to make any moves, either buying or selling, investing, or advising other people who intend to do the same, this video is going to be relevant for you. I hope you enjoy. I hope it's helpful, and I'll see you at the end. Every single thing I create is meant to produce the most meaningful contribution that I can deliver. I want to give people that glad-hearted certainty that comes when life is wisely navigated so that people flourish in every possible way. This down, we've only got 14 slides that are going to tell 3 stories. Story number 1 that we're going to see in a couple of data slides is the health of today's homeowner. What are they like? How healthy are they? That's a significant story as we come into 2022. Number 2 is the overall story of today's market. Everybody is questioning this. We just heard a couple of comments on today's market. And then the third is predictions. This is me doing my best to be able to tell a story of what I think is going to happen. And just like I've always said, test everything and hold fast to what's good. And then I'll let the data speak for itself. So here's the first thing that's really important as we get an overall idea of how healthy is today's homeowner. This is a big deal because I don't know about you, but I've had so many people say, we feel like this is another 2008. All these crazy things are happening with home sales. People are waiving contingencies. They're offering over ask price. It feels like 2008. And most people, a lot of people will actually kind of buy into that narrative. And it's really important that we know we're not in 2008. I'm going to show you here why. I would claim that we are the healthiest that we've been as a country in a long, long time. Some would even argue that we've ever been as a country. And this slide shows it. And just like if you're trying to lose weight, you want to see that line going down and to the right. This is exactly what's happened with today's homeowner. And this picture shows the mortgage debt that homeowners have compared to their disposable income as a percentage. And so you can see that percentage going down and down and down and down. And it captures this average cost, really debt to income. And because of that, we really have never looked better, according to so many economists. We don't have any exotic loan structures like we did since 2010. One of the key data points here is that 40% of all homes do not have a mortgage on it. I'll say that again, 40%, almost 50% of homes do not have a mortgage on it, right? When you look at housing is really the cost of shelter compared to your capacity to own the debt. It's why people buy really a monthly mortgage more than they do the actual sales price. And when you look at this and how the actual price of the mortgage is continually coming down compared to income, it's why this story of debt to income is so important. And it's why you'd be hard pressed to find a time where you're more financially healthy, because your overall mortgage payment, which typically takes up most of the debt for Americans, has now been drastically reduced. So that's one file. That's one story here, one picture that I want to make sure everybody sees. Super, super healthy. Down and to the right is a good thing, healthy. So this next one's really, really important. And what you're looking at is, what's the average credit score? Obviously, the blue is 760 plus. This is really fascinating and really, really important to know. And the reason why we're looking at a picture like this is, remember, if the average health of today's homeowner has increased, and in large part that happened because so many people refinanced this past year. And what does refinancing do when your first number of your interest rate is a 2 or it's in the low 3s? What does that do to your overall cash flow? Does it improve it or does it make it harder?
Improves it.
It improves it, right? So you increase cash flow. Now you can use that additional cash flow to pay down debt. That increases your credit score. So when you look at the average credit score of most homeowners, that has also skyrocketed. When you look at how much money was refinanced this year, it was $40 billion was freed up in additional cash flow in 2021 because of refinance. Let's say it again, $40 billion was freed up in 2021 because of refinances. And so when you're looking again at financial health and credit score, it's another up and to the right here of what we're seeing, that we're doing really, really well as a country when you just look at the average homeowner. So if we're looking at income, debt to income, we're looking at credit scores. What about foreclosures? This is an important one to see. And just like we saw on the first slide, it is down and to the right. Very, very few foreclosures. And when you want to know why, it makes complete sense when you look at the average appreciation that has happened in 2019, especially 2021. And what that's done for people who want to sell. You have less stress sales because people have more equity. This goes against the narrative that so many people are feeling like this is 2008, this is 2008, 2008. In 2008, you saw this huge expansion of credit. You saw this over leverage. You had the ninja loans. You don't have that here in this case. You have high equity. 40% of homes have no mortgage on it. And now because of that, you have very few stress sales, very few foreclosures, very few short sales. And because of that, it's creating this scenario where we have low inventory, we have high demand, and we have a more healthy, what I would call market, so to speak, that doesn't have these huge swings. So that was debt to income. We looked at overall credit score. Now let's take a look at the total household debt balance. And one of the things that's crazy here is that not only do 40% of homes not have a mortgage on it, but if you adjust because of inflation, debt is negative from the housing bubble peak. I'll say it again, it's negative when you compare it to that housing bubble peak. Housing starts just haven't gone up. And the stock of homes that don't have mortgages and the ones that do just haven't looked better because we don't have that huge expansion of credit like we've had in the past that often people are worried about or scared of. So that's really kind of the financial health. It's as simple as I can make it of your average homeowner, right? And all of the implications that it has on whether they want or need to sell their home and how that might affect the market. Okay, let's go to today's market. So obviously everybody knows the story of rising home prices. Right now, builders are loving this because there's such a high demand. Builders have the leverage and builders are doing what they normally do. They're maximizing profit. And the reason that they're doing that is because we do not have a whole lot of existing home sales that are currently available for people to purchase. We have less inventory than we ever have as we come into 22. I think that's the real crisis, is we just don't have enough homes for sale. So builders are doing well. Existing home sales are rising. The median sales price right now, last time I looked, we'll look at Redfin in just a second, $359,000, which is a huge increase. When you just look at this line here from 1990 all the way up, there's a huge increase in prices, huge. And as we go into 2022, I think we're going to see another increase. I don't believe it will be as aggressive as what we saw in 2021, but we'll get there in a second, okay? Next is what we've seen here, price appreciation by metro. You look at us, we're down at the bottom. So average price appreciation that we saw in 2021 was 14%. Who's wishing though that you had an investment property in Boise City? I know I am. 47% increase. That's crazy. Same thing with Phoenix at 33. But when you look at the price appreciation year over year, these numbers are insanity. Washington, D.C. alone, just 14%. On average, we're looking at 4-ish, but to go 14, to put a 1 in front of that number, that's a high amount of appreciation. And this is what we've seen. When we compare that to the inventory, this is what we look and see as the story of existing home sales. We are at fresh all-time lows for inventory, all-time lows for inventory. I'm going to show you another slide in just a second. We know we always fall in the winter and in the fall typically, but what we're seeing as we come into 2022, we're at fresh all-time lows. And people are fighting for homes. People want shelter. People want to have a place to live. And right now we don't really have that much of a pressure release for this demand. And we're going to see in just a minute that inventory is increasingly getting lower and lower. What about purchase applications and people's desire for homes? Well, as you can see, this first number with the black was where we were in 2003, 4, and 5 with that amount of demand. And that's when basically anybody could get a mortgage. What you're seeing here is that we've got a huge demand and increasing demand here, not nearly as high as then, but we also have a lot more checks and balances. Now we're hovering around this 300 level right here on the purchase index. So we've got a big demand coming in for purchase applications for homes. The majority of Americans have low payments because of the low interest rate. Remember, I'll go back. Shelter is looked at as a monthly payment for the most part, as opposed to a sales price. People's payment is low because the interest rate is so low. And more people bought homes in 2021 than in any single year since 2008. And so we look good right now because there's no credit expansion, no massive boom here. And because of that, you're seeing more of a demand on purchase application. Let's take a look at inventory. Here's the story of inventory. You can see that since 2014, we have been going down and to the right with inventory every single year. And now look how low we are in 2021. We continue to drop. We've got purchase demand that's been rising, but we have sellers that are in better conditions than they ever have. We've talked about this before, but one of the main causes I think for this is if you're a homeowner and you have a 30-year fixed at high 2% or a low 3%, and then you have very few homes on the market that you could move into, you're going to be hard pressed to move a seller to want to sell their home, possibly walk away from this historically low interest rate, and then fight for a home that they're now concerned or afraid that they won't get because there's just not enough to go around. So you have less and less people that want to sell. You have less foreclosures because people are on high equity. So therefore you have less existing home sales that are available for people to purchase. And now when we come into 2022, we really have had less inventory now than we ever have. Let's transition to mortgage rates. I think this is probably one of the more important conversations to have. And as a real estate professional, to understand cause and effect with mortgage rates. If you just want to look at one thing with mortgage rates, all you have to look at is the 10-year bond. If you understand how that is a proxy for mortgage rates and you just look at it, you'll be able to actually make more sense of what's going on and what likely will happen than if you listen to the Federal Reserve. The reality right now is that right here, this is one of the guys that I follow on why is my brain not working? Housing Wire. He's one of the smartest guys I think out there. He makes the argument that mortgage rates aren't going to increase. He actually thinks that they're going to decrease. And the point that he makes here that I think is really important is that he says, again, just watch the 10-year note. Right now, if you see the 10-year note break over 1.94%, which right now, last time I looked, we're at 1.73%. The moment it breaks over 1.94%, mortgage rates will go up. He doesn't believe they'll go up into the 4s, maybe the high 3s, but we haven't come anywhere close to 1.94% anytime soon. 1.73 right now, we've got a long way to go to 1.94. And that's what he recommends. It's what I would recommend that you watch as you want to monitor interest rates. If we get close to the 194 or break over it, you're going to see an increase in rates. If we don't, if we stay where we are, he thinks a lot of economists think that rates actually could go down. Regardless, if they go up, most people are saying maybe 3.5 to 3.7 is where we might end in 2022. If you look at Fannie Mae's predictions for their 22 mortgage interest rates, they've got max of 3.8. But this is something to watch. And even more important, as you talk to clients, just know the 10-year note and how important that is on the mortgage interest rate. You can track that every day. And just use the 1.94 as the benchmark. The closer we get, the higher the rate will go. And if we're not there, likelihood is we stay where we are. Now, if you look at, I'll show you this in a second. If you look at Zillow's mortgage rates, they give you the year over year, week by week, month by month comparison. We were at basically 2.82, I believe, a month ago. Right now we're at 3.3, I believe, on a 30-year. So we've seen a 0.5% increase from just a month ago. And if you know the 10X rule in real estate, which is every time an interest rate drops 1%, you see a 10% increase in prices. Same inverse is correct. If you see a 1% increase in rates, you see a 10% decrease in prices. If we saw a 0.5% increase in rates, you would assume there'd be a 5% headwind for prices. It's not necessarily what we're seeing because you've got such low inventory. You still have mortgage rates that are low. And so you're seeing something happen here that we typically don't see when you look at that 10X rule. But this is an important story to track. Again, track the 10-year note. And this is what we've seen here on the 10-year bond, is this is what it's done. Since 1985, we're just moving down and down and down and down. into 2020, 2021, and 2, we're at record lows here. Okay, so this is something just to track and make sure that you're aware of as you talk to clients. So let's go into predictions. This again is how I see probabilities as we look into 22, and a couple of bullet points here that I think are important to track and at least have your mind around. Most economists that will talk about forecasting, they're saying a 5.1 to a 7.4% appreciation year over year. Obviously, local markets are going to differ. Maybe better if you're in Boise and you had a 47% increase this past year. But they're saying 5.1 to 7.4 appreciation year over year. And despite new single family home construction being in high demand, supply has been hindered and will continue to be when you look at both the basket of goods needed to build a home or renovate a home, and then the labor that you need to actually use that basket of goods to build a home or renovate a home. We're looking at some serious constraints here, and most experts believe this is going to continue into 2022. So as you're giving advice to clients who want to build and or renovate, just know prices are going to be likely up, and so will labor, and labor shortages are probably going to be a thing for 2022. Most people are not seeing a release of that. That's one. Two, total home sales will decline to 6.54 million is Fannie Mae's projection in 2022 from 6.77 million in 2021. This mortgage interest rates, 30-year, 3.3% is what most people are saying is probably going to happen. And so that's something to keep in mind here as you look at these 4 real levers that I think we're looking at. Thanks for watching this video, folks. I hope it was helpful, and I hope it gives you the information that you need in order to make the best decision for you in this year. As always, I appreciate your attention, and I'll see you in the next video. Take care. Bye-bye.